Give it a few minutes for people to log in.
Trader McGraw key. Do you know offhand how many people that listen, like at least understand options delta, what a delta is, or we don't even know that?
I have no idea, especially on social media, who knows what, or
Who
even
knows?
in the room. But I think if you start the discussion with basic Greeks, we'll be here till 2:00.
So in talking about.
I mean, you could get some very
in talking
basic
about
stuff.
Gamma, I'll give like a real basic 2-minute overview on Greeks.
Sure.
I mean, it has to be some kind of vague understanding of what it is for it to even make sense, I think. Right, Alec, I'm going to use Alex as my Greeks consultant. And you can start off in your little intro with, the fact that when I presented this idea to you a couple of years ago, you were skeptical, and rightly so, and then you've kind of come to see, somewhat of the utility of it.
Of course. All right, so I know it's going to record to YouTube, but I'm going to record this anyway. All right. We've been waiting to have some time with Trader McGraw, which I've known for a few years now. And we're going to have a discussion about trading SPX credit spreads that expire each day of the week. They're a great instrument for income trading. It's not for the faint of heart, but doing it intelligently, batting average is tremendous, meaning the wins are extremely high. You have to have a method for doing this, as you do with anything else, which we'll talk. But getting everybody an understanding of what we do, what we give the levels every morning that we're looking at pre-market here, that's streamed to Twitter and YouTube and Facebook and such. So this session, we're going to have a discussion with McGraw about what he looks at, some of the things I've learned that he has shown me over the years. And so a little background of how this started. McGraw's in the green room with us here. And as he evolved into trading SPX credit spreads, and he was learning the master trader method of charting and what we do here. And he said, hey, Greg, look at this information about gamma and some Greeks information and so on. And I was like, man, honestly, I kind of resisted tremendously because I'm not interested in esoteric type of trading and anything that's actually complicated. Of course, the of you that know me, if it's got an indicator on it, I'm not even going to look at it. And so as he continued to show me a few things and just to be nice and give feedback to anyone who's a subscriber, I began to look at the information he was sharing with me. And I was like, this stuff lines up with technicals, the charts, and how I look at things. And he saw that, hey, at these levels, it's interesting how these levels kind of come together. So the idea of what I saw was that here's a different trading instrument that institutions were and do primarily trade, and the more esoteric type of information that they're looking at is bringing them to levels that I was looking at based on the pure chart analysis. And so I said, okay, I'm going to delve a little deeper into this and learn more about what McGraw will explain. And it's good, useful information, not only to add to your trading, to know what's happening in the broader markets intraday, but also for a tradable instrument to profit from. So with that being said, let's take a look at this, McGraw, and we'll look forward to hear, as you understand this on a deeper level than I do, but it's all good. So.
Okay. Hi, everybody, and thanks, Greg. Let me start off by saying that when I first came to Master Trader, most of my trading, I had been an options trader for years, but most of my trading was based on how the options might move, and my technical trading was based on, DMI crossovers and bands and all that kind of stuff. When I got to Master Trader, I basically learned look left and get all that nonsense off your chart. And I was resistant to that until I learned, and now my charts are real clean and I look left. And so I want to thank Greg and Dan for that. And I guess similar to Greg had his method and he was resistant to changing it, so was I. So let me first explain a little bit of what this gamma thing is all about, and then how it applies to trading in general, the market, and to SPX credit spreads in particular.
Hey, McGraw, before you continue, bring the mic a little closer to you. Some of them on the social media say the volume's a little low, but they say it's getting better. Sometimes you got to bring the mic a little closer. Or in your audio settings that you looked at before, where it says test mic, there's a volume thing. You could push that over to the right.
Is this any better?
I hear you fine. I turned my volume up, but some of them said that their volume was up all the way. Go ahead, keep speaking. And
Okay, all right. So the whole idea behind this gamma scalping and people talking about gamma is that market makers are on the other side of the trade. And so when we see 1,000 contracts come in to buy or sell an SPX or a SPY options expiring today, somebody is on the other side of the trade, and that's usually a market maker. Market makers, dealers, Citadel, Goldman Sachs of the world aren't taking directional risk. They're not making the bet that, oh, it's going to go there or not. So what they do to hedge their risk is they sell you the options or buy the options from you, and then go long or short, buy or sell whatever the underlying is that represents. So if you would buy an option worth let's just say 1,000 shares of SPY, they would short the equivalent amount of SPY and make their money on the spread, and then adjust how much they short throughout the day. So what gamma is it tells us how much of the underlying the market makers have to buy or sell to stay neutral. Now, this isn't done every second. It's done at the beginning of the day, at the end of the day, when big orders come in. So that said, I put a quote in there before. I don't know if you can share it with the folks on the different platforms. I'll read it to you. Zero DTE gamma and daily market structure implications for 6.5 hours or less of trading. 70% of equity notional traded on a daily basis is now options. Let me stop there. That's what that means is of all the trading that goes on the planet on a given day, 70% of it is options related notional. So what that means is if I buy a contract for whatever it is and it controls 100 shares notional, let's just say $100,000, I might only pay $2,000 for that option. So it's not saying that the total volume of dollars is, but the amount of dollars that's controlled by those options is that high. And so again, market makers have to hedge that. Okay, so now let's get into the nitty-gritty. When I'm trading zero DTE credit spreads, I'm looking to sell options where it looks like the market's not going to go. So first level of analysis is always going to be looking left where the support and resistance is based on where buyers showed up before or sellers showed up before, the way Greg taught me here at Master Trader. However, and here's the big however, depending on what's going on in the options market, there's a definite bias toward what's going to happen when certain levels break on the option chain. So, for example, right now, as we're speaking, if you look at SPX, go in your option chains, you'll see that 4,100 and 4,000 are big strikes. Lots of options are there. So at
McGraw, let me bring up an options chain and we can look at this together, and so they can see and you'll see whatever I'm displaying. And hold on a second. So what I can do here, this is in part what McGraw has shared with me over the last couple of years, and what he's going to explain to you about where these levels are in this particular platform. I can sort the column. So what I do is I just sort this by open interest, and it'll show me, with the expiration of that. And then over here, so the greatest open interest is at 4,000, expiring in 8 days. What's interesting, it's also on the put side at 4,000, expiring in 8 days.
Yep,
Now, McGraw's, your software is a little more, I just say better as to where it, I believe, if I'm assuming correctly, McGraw, that your software can look at all these different strikes and kind of accumulate at that strike, I guess, not only separately, but also on multiple expirations to see the potency of that strike level.
Right. Okay. And now, so I'll do a little screen sharing. I'm warning the people watching, I'm not a master screen sharer, but I'll figure it out and we'll see what, hopefully this will be useful. You want to stop?
Yeah. So just share your screen and it'll automatically take it from me and you can display it. There you go.
Okay. So what this is that we're looking at right now is all the SPX options open interest on the planet. And you see the puts are the teal and the bright green are the calls. And so this is for every expiration from today through, whatever it is, 2027. That's how much, that's where everybody is stacked up. You see 500,000 calls and roughly 500,000 puts, pretty much even Steven. Now let's go over here to 4,100.
Let me give them a perspective of what you just said. And
Okay,
he
sure,
said
please.
500,000 calls and 500,000 puts. The screen that I just showed you that expires in 8 days, there were 83,000 calls, 84,000 puts. So other than the 8 days, there's the difference is that 250,000. Because
Right.
what he's explaining to you is going out even further in time. So still that 4,000 level is a super significant level.
Right. Now, the days is important, and I won't get into the weeds about the Greeks of it, but just think of it this way, the options market makers don't have to hedge their 4,000 calls or puts in 2025. It's, it moves in a minuscule way. Just if you were long or short an option there and the market went up $5 or $10, $20, nothing would really happen. So all the hedging has to happen closest to expiration and closest to the current strike. So here we have 4,100. That's kind of where we've been fighting lately. 4,100 puts and calls. Now this is in the whole chain. I can dig something up in a minute that'll show what's going on a shorter time frame. But now I just want to show you what this gamma thing means. So that's the options volume. Now let me see what we have. Okay. So now gamma is how much they're going to have to buy or sell to be neutral. So here we see that 4,150 is the biggest gamma strike on the board that's closest, and then 4,200 right next to it. So if we get over 4,150, then this starts to go in the money kind of thing, GameStop or AMC gamma squeeze that you might have heard about on TV or whatever, but not to that crazy degree. But we had stuff like this when Powell, talks and suddenly we go flying. It's a variation of this. These options are stacked up. We start to move up. Volatility comes down, which makes the deltas of these options change. And then off we go to the races. So
McGraw, question, what
Yeah.
you're showing here, before you said the other screen was volume. Now you're
Right.
saying
Well,
this one open interest, or you said it's gamma?
the other screen was open interest, just how many options? This is gamma.
So gamma, so this is where my confusion was. I explained so everyone else, maybe they're thinking the same thing. Because when McGraw first showed this to me, and the way he explained it, right, he said gamma is how much they will have to buy or sell to stay neutral. So, okay, someone is going to buy or sell. What is the definition of gamma? Essentially, it's the speed at which options move, correct?
Correct. Okay, so let me try to give a very not in the weeds explanation of why we're looking at gamma. So people buy or sell an option, and the assumption is that market makers hedge flat by selling or buying an offsetting amount of the underlying. So that's their deltas. They hedge their deltas flat. So if you bought an at the money put or call, that's a 50 delta. So if you bought the call, they would sell you the call and then buy an equivalent amount of stock to make up for that, or vice versa. So once they're hedged flat, the amount that they're going to have to buy or sell going forward is represented by gamma. They no longer have to hedge their delta. The way they know how much delta they have to hedge flat, how much more they have to buy or sell, is based on gamma. So
Right.
think of it this way. If if you have an option that you buy that's, a couple dollars, that's close to the money, then we start to go up, that option might double or triple in value. That's the gamma of that option. So this is the gamma, how much they have to hedge in their whole book. So let me show you. Okay, so right now, look, the screen I'm showing you is a gross gamma. So this is put and call gamma over here, which basically looks like the open interest chart. Okay, but if we look at net gamma, if we subtract the calls from the puts, these have numerical values. If we subtract that, then we go from gross gamma rather to net gamma. We subtract the puts and the calls and we get this. So why is that? I'll try not to make this a lecture on gamma, but I'll just, so why is that? Let me go back to this screen here.
So, McGraw, let me just add my perspective of what you're talking there, because I'm always my understanding things is to knock it down, to define it to its most basic things. So as I began to understand what McGraw is looking at, and as I look up the definition of gamma, well, that's a static thing, but it's static when you just say, what's the number? And it's not moving, right? So we're going to say we know what the net thing is and what he's going to explain. What in my mind, the way I see it is like gamma is what is the potential for prices to move quickly. And so as I combine this with chart patterns and support and resistance and voids, that number becomes a significant number as to, and make an analogy of like, here's a situation that has the potential to be explosive. And if you understand it, and from my point of view, again, looking at it with a chart, it's like, okay, everybody's standing there watching this thing and there's the potential as to move. And it's like, who's going to throw the gas on the fire? And that's kind of like the gamma, because based on when McGraw's explaining is here's the potential for prices to move. And then what's going to ignite it is how I look at it. Go ahead, McGraw.
And what's going to ignite it is going to be when certain levels cross. So let me just, and it often corresponds to where the price voids are that Greg shows based on where the options are, just like we have those big whooshes down to the next level down, price void up, price void down. Same thing often happens with gamma. So if we take a look over here, this is the gross gamma, adding up the puts and the calls, and you see they're roughly the same. At 4,100, at 4,000, they're really they're just about the same. But if I look at the net gamma, subtracting out the value of the puts and the calls, where is it? You see the 4,000 is just a little bit negative, more puts than calls, and here the 4,100 are positive. The further away you are from that options chain, from the option strike, the less pull the puts have, the more pulls the calls have, or vice versa. So if we started heading down to 4,000 to 4,100 rather, this bar would start to grow. And market makers would have to start hedging, shorting to get flat. I see this area right here as while I'm at it, this is the zone right around here, 4120, kind of right where we are now. This is every option on the planet Earth and SPX. And look where that is, kind of right where we've been. So in theory, this is where the market makers would want to park today to have to do the less hedging, or where the hedging flows would balance out, all things being equal. Another parking zone would be up here. And then if we got over 4150, it would be pretty much a straight run up to 4175. And these are all levels we know. So this is just going to kind of tell us how much it's gonna accelerate, how much risk there may or may not be. So now, so getting back to today, for example, I sold options 4090 down here. I sold a few at 4100 because I believe that this 4100 is not going to break based on what the market makers have to do to hedge it. So I might take a little heat as we go down, and I did. And now most of those options are bought back. I put in a buy to close and they're gone. Let me see if I can, okay, so take
Oh,
over.
draw a question. So based on what you're saying here, right, the assumption is, and we know that technically that 4,100 is a significant level. If it breaks, please explain based on that level, what's going to happen with market makers and why?
Okay, so if that 4,100 breaks, then the market makers, so gamma is greatest at the money and shortest in time. So if that level breaks, then all the long stuff that they had to buy to hedge those calls, they start really dumping. And whatever shorts they have to hedge the puts, they have to start hedging even more. And that's when we get those levels breaking, we get that big whoosh down. 40-50 is pretty much the next level down, other than, you know, maybe a little a little blip at 40-75. Let me pull something up here. And as you can see, I have, you know, I use lots of different tools here. This is kind of what I do. So let me see what chart I have here. This is options volume. So this is options volume for today that I pulled up. So it's showing the 4,100 puts as the most action and the 4,150 calls. The 4,120 puts were lighting up as we went down. People started buying more and more of those, and they kind of rolled down to the 4,100s. Now the 4,100s are losing value. The market makers had a hedge short, had a short as those puts were being bought coming down here, and that kind of sucked us down below that 4120-25 area. Once we stabilize and we start to go up a little bit, then they can start to buy back the corresponding shorts, and we get the turnaround. I want to. Okay, so this is a similar view, but I'm gonna put this is what today looked like at the beginning of the day. These were the two gamma flip points. Actually, no, that wasn't the beginning of the day. That's what it is now. And there's that 4115 where there's some positive gamma. There's some calls there that are gonna kind of, you know, stop the rundown. And so once we broke, you know, we were teetering around the 4150 area in here. People were buying or selling these options, and market makers had to hedge that. Once we broke that, it was pretty much a guaranteed suck down to over here. That was, you know, and so I actually grabbed a quick short scalp. I bought some 41 30 25 or 25 20 put debit spreads. Once I saw this breaking, I know we're going here. I just know that they're going to hedge it to there. I also kind of know that we're supposed to stop right around here.
So McGraw, you said once you saw it break above 4150,
Below, when I saw below, break below this 4150, 4145. Once this level gave, you just kind of
meaning,
look at the size of the bars, just kind of think of it
I
almost
get,
like a chart, forget the math behind it.
I get
Once
it.
this breaks,
it-
there's nothing here until down there.
I got it. So it gapped up this morning.
So it
And
gapped up this morning and staying around here, 4150, was fighting at 4150.
Yeah.
People who bought those 4150 calls yesterday, or let's say, first thing in the morning, people who bought those 4150 calls yesterday and who bought the 4120 puts, there were a lot of at-the-money puts that were bought yesterday. Well, those at-the-money puts that were 4120 lost basically all their value at the open. People who owned them sold them. Market makers can buy back their shorts. Even if they held on to them, market makers hedged the deltas, and those puts were a higher delta yesterday than they are today. So market makers got to buy back. So market makers got to buy back. Up we go. We're fighting around this 4150 where there were some calls. There were some buyers there. There were some buyers that came in and tried to buy, like, higher strikes, 4175, whatever. Some hedging happened. At some point, people who bought the calls sold their calls. And then as we're stalling here, whatever puts that are still left in there, as we're pulling back, are now gaining value. Now market makers have to start shorting again, to start hedging again. Once we break here with all that volume down there, that becomes the magnet. That becomes a magnet. Once they get here and they kind of hedge it flat, then we kind of stall. That's where we kind of stall. Now, I noticed, because I watch the options chain, I use this kind of stuff, unusual whales, to see where the flow is coming. I look at all these different tools. Once we start to stop over here and the 4100 puts stop being bought, then market makers turn around. And that's that's basically what we've been seeing all day. Oh, I looked away, and look what happened. We're going back down. So I'm guessing that that they're hitting the 4100 puts again.
so the chart I just posted in the room there was that 4150 level where we had the high volume and the topping tails that were forming there. So every time it tried to go up, and you're saying they were buying these calls, of course, they're anticipating it's going to go higher to profit. And then we look at the technicals and see it keeps getting rejected as it tries to move up, which means someone else is saying, I'm going to keep selling, come bearish. And then eventually it breaks and things go down into the gap fill area.
But now, this is a chart, not perfect, of options volume today. And you see the 4100s now, where we have 36,000 volume. That's the biggest volume area of the whole day. So that's what they're pounding right now. So they're buying those puts. And you see this little teal thing? That's the latest volume, so they added over here. They didn't add over here. They didn't, they might have added a little bit over here, but they added over here. And now we also see a few call buyers coming in right here, 4120 near the money. Maybe looking for a reversal or whatever. We're not sure when they bought it. But right now, this is the target. So as soon as we stall, if we stall, this should reverse. If not, then we kind of slog down into here, and 4090 is quote unquote supposed to hold no matter what. I'm still thinking 4100 is going to hold. I don't think these people are going to hold on to their puts forever.
And there's a void down to that level. It's coming to a pivot at 4110 right now, but it's got room down to 4100 and a little below. Actually, the significant support is down below that.
Right, we just took out yesterday's low, and that's, so I mean, right now, the bears are in control. I mean, it's that simple. And part of what's going on, if you look at VIX, we have CPI coming up next week. We have some Fed speakers tomorrow. People are buying hedges, buying puts, buying VIX calls, whatever it is, making VIX go up. All things being equal, let's pretend the underlying doesn't move. If volatility goes up, you know if you're an options buyer or a seller, the value of that option changes. So from the point of view of delta or gamma, the delta of that put would increase if VIX went up, even if it didn't move. So now they have more deltas to hedge just based on VIX going up. And now let's throw on top of that price going down. That creates even more of a need for a hedging. So right now we have fast and furious hedging. And right now it's, let's see what happens at 4,100.
Yeah, and technically it might stall there because of this option activity, but you're like, it's a fence, you can push against it. So the significant support is down below the 4,100. So if it does get down, and we're talking about SPX, 4095, 4090, you're just going to have natural buyers there just because things are moved to that level, and those are where the prior lows are at.
Okay, so now what this is a chart of delta flow. Are they buying or selling puts or calls? Let me simplify it a little bit by making it total. So this shows total, so puts being sold or calls being bought is positive delta. So you can see here, as we're going down, all of a sudden you have some positive deltas come in. Now that could be people selling puts that they had bought previously. It doesn't matter. Then you see the market makers start to respond. You see positive delta flow coming in over here. So we're stabilizing. So positive delta flow is probably people selling the puts. We're stabilizing. Negative deltas start coming in, and over here, and here you see spot was whatever it was 4120. Over here, negative delta started coming in. People started either buying puts or selling calls. Now it looks like we tried to get a little bounce, but it looks like they're just kind of pounding it. So you got to wait and see what happens. Looks to me like we're going to test 4,100.
I agree.
Except
Technically, I see
4110.
no reason for them to buy.
Uh,
I agree with you, because technically there's no reason for them to buy other than, on a short-term basis right now, prices are a little extended because they've dropped as much as they have in the last 15, 20 minutes.
Okay, now you see this little flip here in the blue line. It's some positive deltas are coming in. Probably what that means is people are selling their puts. Not a lot, just a little bit. But it looks like the battle line has been drawn, and okay, see that little pop up there in deltas? Whether it's buying puts or selling or closing out calls, that should give the market maker hedging relief. See that? So we should start turning up. Spot should start turning up.
And it is. And so
See, I'm not looking at price chart. I'm just looking at the delta flow. Was focusing up here.
I know, and this is what makes it interesting based on, how I look at things, how we mass traders approach is, why would prices now begin to try and stabilize? And it's the concept that we call greater than 100% retracement. I mean, prices fell as far as they did, if you're looking at your SPY chart or SPX, they traded below the low at 320 on Wednesday. So based on breaking that low, that pivot and coming down as much as it had so quickly, odds are it would stabilize. Now, how much it bounces, I have no idea because the selling was very strong on the way down. I would think it
And
has to
now,
go.
taking it from a gamma perspective, people who are buying or selling options are looking at charts and they're looking at price action. So whoever bought those options, the 4100s or 4120s, wherever it was, they were getting more and more profitable. They see we're getting to a critical level. They're looking at their charts. Greg taught them how to look at their charts, and they say, "Oh, we're probably going to stall here." They see it kind of stall. The momentum slows, so they take the money. An option, a zero DTE option, is not like being short the underlying along the underlying. We can just take it home and swing it. These things lose their value exponentially as the day goes on. So they're jumping out, taking the money, and now the delta flow. And so you can see more and more people are closing out. So now I got this toy here. I can separate it into puts and calls to see what's going on. And you see it's more, it looks like some calls are coming in. Now they could be buying back short calls. On the put side, puts are coming up. So it's positive delta, so they're selling puts. Now you see it's starting to turn down again. Looks like put people are coming back in again.
Yeah. Let me, to what McGraw said, kind of like so everybody understands the leverage involved with this instrument. I mean, and McGraw, you've seen it as more than I have. Of course, you do this more than I do, but I mean, I have seen these things near the end of the day, and you believe they're worthless, and the market, for whatever reason, makes a move, and these things will go from like close to worthless to being money wise. You don't want to get on the wrong side of this thing because, I mean, it's just amazing how much it can change in value in a short period of time, and then collapse again.
Yeah, and that's because they will all go to zero.
Eventually, yeah.
Except for the one, unless they're in the money, then it's whatever, however much they're in the money or out of the money. But anything that's not in the money or out of the money will go to zero at the end of the day. And as you saw from the thing that I mentioned earlier, about 45% of all SPX options traded now, based on studies by Goldman Sachs and Nomura and all the people that study this stuff, they may be off 5% or 2. 45%, give or take, is SPX 0 DTE that's going to expire in 6.5 hours. So market participants aren't making a big bet on what's going to happen for the CPI, on the recession that's coming or not in June or September or whatever. Market participants and hedge funds are in here and algos are in here, are all doing this based on getting that quick scalp of what's going on today.
It's heading back down toward that 4100. And what I was typing into the chat is that greater than 100% retracements aren't a reason to go long, but you might want to take some profit. But once it gets down into that chart that I displayed, that green area, 4100 to 4090, that's where things might get climactic. It'll begin to bottom out. Maybe it'll begin to, go sideways until, after 2:00, and it might bounce back up from there.
A bunch of my puts closed. I didn't have them all. I had them at different prices, so a few of them are still open. So now what I might sometimes do, since I've got a captive audience, let me see if I can, let me stop screen share and take and try looking and see if something else, see if that'll help. Hold on. Think- Lately, get back to that screen share. Okay, what we see here is a chart of that, a 1 minute chart today of that 4100, of that 4100 option. The chart of that put. Here you see where the buyers are, the big green. So you see right there at 1218, buyers, algos, whatever it was, jumped in and bought 1,000 up. Look at that, they bought them at $1, 94 cents. That's $7 now. So somebody did okay. And then there you see they were nibbling, they were buying them all in here. So I'm gonna look at the flow. You see, they're still buying. They're still buying. So I'm gonna look at the flow and see what's going on in these options. And it looks like there's still buyers. People are, but they will be getting out of this soon. You can almost read the option chart like a stock chart. You start seeing these topping tails when you see the option prices so far away from VWAP. Generally, you're going to get profit taking. That's still climbing. It's going parabolic there. So then I might take a peek. Okay, what's going on at a different strike? So now I'm looking where the volume is, 4,100. Are they hitting the 4080s? If they hit the 4080s, those are starting to fade a little bit. And once these start fading and closing, then that's gonna let the market makers start selling the hedges that they shorted for that and gonna turn the whole thing around.
So McGraw, question on SPY, and we look at the same kind of information. The puts at 410 has the largest open interest expiring tomorrow, and it's got relatively big volume. The biggest volume is at 412, so they're already in the money. So the 410s it broke, and that's a large open interest. So that the theory behind the gamma is that is what in part is helping fuel this thing to go lower.
And at the same time, which number are you looking at? Which one's the 410s?
The 410s on SPY, that's 26,000 open interest and 83,000 volume, but that expiring tomorrow. The 410, the 412s have the biggest volume today.
And so here's the other side of the point on this. Especially more so with SPY than with SPX, because the assumption is SPY is retail and SPX is at least a little bit more institutional. Retail, who if you're long a SPY put, at the end of the day, you have the right to be short SPY. SPX is cash settled. So if your put is in the money, you collect the money. So the assumption is people who own these puts aren't going to want to be, if you own 10 SPY puts that are in the money, you don't want to wake up and find yourself short 1,000 shares of SPY. So you're gonna sell it. You can take the money and sell it, simple.
Mhm.
And so the potential for tomorrow or maybe later today is for people to monetize these puts. When people start selling these puts, things turn around. So market makers had to hedge all that short for those, whatever it was, those 410, 412 puts. They have to be short a lot of SPY or ES or whatever instrument they use. Once people sell 100,000, whatever the crazy number is of those puts, market makers get to buy back their shorts. Oh, look at this. We see they're starting to sell them. It should be turning around. I don't have to look at a chart. I mean, I do look at charts, but I just look at what's going on with the options market, and I can anticipate that what the chart is doing, or even if it's not, it soon will. So let's see what's going on with our friends at 4,100. What's it? Expiration. Yeah. Okay, so the price is going down on these. They're starting to scale out. Now, that doesn't mean they're not going to hit them again, but they're starting to scale out. This is algos mostly doing it in some retail. You see when it's 1,000 in 1 minute, that's an algo. That's not 1,000 people at the same second getting religion. When you see these little, 23 contracts, whatever, that's you, me, and Greg, and Dan, buying and selling a few options.
Is that a credit spread, McGraw? That's the SPX W230.
Wait,
Or that's just the middle of your
no, that's not good. That's the
symbol?
symbol SPX weekly, 2,300 a year, and it's the 4,100 foot. That's all that is.
Got it.
That's just that's a chart of the option
Mhm.
price, volume and price. And so the takeaway here is looking this morning, and I have lots of other gamut charts that I can kind of share, whatever. The 4,100 was supposed to hold. We had the open interest of, okay, so we only had 5,000 open interest. See, there's not that much volume sitting in the chain in the morning, but that's going to be what's hedged the most. What's really driving the bus is the AM expiration. That's where the institutions play. Now, if we look in the AM expiration, we see open interest of 15,000 here at 4,100. But if we look down at that big 4,000, we have 84,000 puts there and 83,000 calls there. That's where the real battle line is. And so, since it's a week away, the hedging response needed to hedge this out is not great because we're kind of far away. But as we approach that 4,000, the market makers are going to have to hedge a little more. If we look at the delta, so those are a 21 delta. That's starting to be significant.
Why? Because it's getting closer to the money?
It's getting closer to the money. So 84,000 contracts times 20 delta, let's call it a 20 delta is 1/5 of that amount. The delta of 100 equals the amount of the underlying, equals, 100 delta is the same as the stock or whatever the underlying is. So that's 1/5 of that amount. Of underlying that they have to be short. And again, if we look at the open interest there, we had 84,000, whatever the value of that is, one fifth of that is a lot of money. If I go back to one of my other charts, I have a chart of the notional value of what has to be hedged at different levels. And these numbers get pretty significant.
So McGraw, question. About a week ago, that open interest at that 4,000 was about 100,000 greater than what it is today. What was the implications of that and the reduction over this amount of time? 84,000 is still the biggest that it is now, but my memory serves me right, it was closer to 184,000 about a week ago.
I'm not sure what the exact number is, but, and I could dig into it and actually see if I can find a more exact.
I would think it was at least double than what it is right now.
But I would say that people were hedged for the FOMC and for whatever the events were, and they took it off.
Okay. So Paul,
I got another chart.
Alex is asking what percentage of winning trades is needed to stay afloat or break even? And he said, would you say that what you're doing is 100% quant?
I guess one might look at it that way. I don't look at it quantity. I'm not really a big I know this may sound counterintuitive, but with all this math quantity stuff, a lot of it goes on intuition and experience and feel. And as far as what percent you need right, it's again, just like Alex, you know, from trading, it's not the percent you need right as much as not being wrong. Because
controlling losses.
2 or 3 put spreads expiring in the money and you wipe out 3 weeks worth of gains.
Sure. I mean, that's the nature of trading credit spreads.
Right. And so that's the fly in the ointment. Now, another thing, and this is my pet theory, not I've floated it by like some of the gamma gurus, and they just say, yeah, maybe that. I haven't really gotten anybody to sign on it. But my pet theory is that algo. Okay, so let me back it up a step. Your standard 0 DTE, iron condor, low delta sellers sell whatever it is, 5 delta, whatever they sell, and they put in a 2x or 3x stop loss buyback. So if they sold the option for 75 cents, they put in a $1.50 or 2 1/4 buyback or something like that. So if I'm an algo, I know that.
Sure.
And so I'm going to sell you my 5 delta puts and calls at the open, knowing that I have 3x buyers, buy orders sitting in there in the book. And then I'm just going to sell them back to you. And anecdotally, I'm in some of these other rooms where people like, you know, are real strict with that method. And I see them time and time again. 4,100 stopped out, 40.95 stopped out. And once I stop seeing people saying stopped out, stopped out, stopped out, we turn around. So I think the algos are sniffing that out as well. And that's kind of creating an artificial demand for some of these out of the money options. My own pet theory.
Yeah, well, anybody could calculate based on looking at the volume at a strike today, which at a large level would be like, okay, you know, technically I would look at a pivot on a chart and say, look, if it pokes through there, there's going to be some type of a reversal, and they trade against that. Like what I say, the concept of a greater than 100% retracement. It pokes through that low, or that level where there was a culmination of activity there, and it gets undone, so to speak, and you get a stabilization and maybe a small retracement, which is what we saw about 20 minutes ago when we were talking. It was a small retracement, then it went lower, and now it's still, working its way down toward that 4,100. So, question, Reagan Ann, when do you decide to bail out of an SPX trade when it goes against you?
If I see a level breaking and I see the flow coming in at or below that level, I think it's going to pull it down. So I don't have a mechanical. If this breaks, we go. I have, and so today 4,100 is not supposed to break.
Right.
And so if 4,100 breaks, I might cut my losses. I'm out of most of my put spreads. Now the other thing I do is I put in a buy to close at different percentages. I put in some at 50%, some at 65%, some at 70%. So a lot of my options are gone on that little bounce. Half of my options got closed at whatever was 35 cents that I sold for 70 or 80 cents. The ones that are still there on this turnaround are hurting again. So I'm gonna have to get back to manage this mess in a minute. But I'm gonna be waiting. I might look to, at this point, I might look to opportunistically just get out, see if I can get out, scratch, break even on the rest, or maybe lose a little bit. But it's still a little early in the day for me to make that decision. Or I might, I create what friends of mine call Frankenstein spreads, where I might buy long puts or put debit spreads around my short strikes to kind of cushion the impact. Don't try this at home, kids, but that's another thing that I might do.
Right. Well, I think that's a wrap. We did great. A lot of information. I hope everybody enjoyed it.
I hope it was coherent enough. I didn't prepare a presentation. I just kind of winged it, which is my style.
It was great. It was good information. And, as everybody hears new information, they kind of let it gel in. And, those in the green room can ask questions when, trading is slow. And of course, it's above most heads, John. When McGraw first told me this stuff and I started looking at it, it was like, forget it, but he was persistent and kept feeding me information, and I started to read it and was like, okay, I see where this makes sense from my point of view. I don't look at things as in detail as McGraw does with what he's showing us, but I can come to a conclusion as to where there are significant levels with, and see if it lines up with the chart. And I find it very helpful, to combine that information.
From my point, you don't have to be nearly as in the weeds of this on me, let alone gamma and Bowman second and third order derivatives of the options, Vegas, and all that kind of stuff. To just do what Greg said, look at the open interest and see where we expect the hedging response to kind of reach a crescendo. And that tends to act as support and resistance. And it just kind of adds, when there's confluence between the charts and the options level and what we expect the dealer response to be, that helps me not get shaken out of the trade. Most of the cohort of zero DTE traders that I know today, everyone's been stopped out at 3x loss 2 or 3 times because I'll go in again and go in again. And I'm still holding mine. A bunch of mine will close at a profit. And I'm pretty confident here, as we see that bond and tail again, that at worst, I'll be able to get out of mine profitable on the bounces, because each time we go up a little bit, as the day passes by, the value of those options starts to shrink. Those deltas change really quickly, and 30 delta option on a 5-point move later in the day becomes a 15 delta option really quickly, and that changes the value a lot. So there's a lot of those moving parts in there that give me the confidence to just hang in there and not get cut up.
Right. And what, McGraw, what you said about, some of it is experience and feel, I totally agree, because when you see how these options move and you can combine that with the chart where essentially where there's some kind of a floor or a ceiling that things aren't going against you, that experience of seeing how fast these options, something can be against you, could be back to break even or profitable so fast because of the time decay that's happening, as you get in the latter parts of the day. So yeah, it's definitely a balance where, maybe a purist option guy would have some kind of a option chart that would show price and time. I don't know, but
Yeah, there's all kinds of risk graphs and things that show that. I don't really even use those much. I guess because of experience, I kind of have the chart in my head. I just know how these things move. But like
right.
you said, from experience, from looking at it day in, day out, like every day. I've been doing this for years, and out they have it 5 times, out they have it every day. And so, there's that experience factor.
So what I'm asking, I'll just share this and then we're going to cut it here. Someone on YouTube was asking about waiting for a specific setup. And those of us that use charts, and most of us, of course, do, think about that specific setup, which is helpful, but sometimes it doesn't work because of the time decay. Meaning you can see something you thought was going to go down and you waited for a retracement. And because of the time decay, those options are now worth less than what they were, when it was lower. So that's kind of part of the balancing act as well. But I would say generally, as I look at what I'm always thinking fading a move because that jacks the premium. But when it reaches a support level, so, the premium is getting popped, and then you might say, well, I'll wait for a W bottom. The W bottom might take 10, 15 minutes to form. And whereas now you've got a technical pattern where you'd want to do directionally, those options could be worth, a quarter, a half of what they were before. So
now, and a setup from a gamma perspective, today wasn't a great setup. The setup was for a long if it happened, which it didn't. Yesterday was a perfect setup for a short, and I set it up in the morning. So without going into too many details of what I saw similar to today. If we, if we open below a certain level, that we would have to go down because we were red overnight. So that means that the market maker is going to have to short to balance their books. So I jumped into a 40, 20, 40, 30, 40, 25 put debit spread. It was actually a condor structure financed by selling 40, 90, 40, whatever was on the bottom, probably 25 wide or 30 wide on the bottom to pay for it. It cost me 5 cents to put that trade on. 5 cents because of the puts that I sold underneath it. Being confident that the setup was we should whoosh to 40.25 just based on where the options were, and we shouldn't break 4,100. So that trade expired. The 5 wide put debit spread fully in the money. So that was $500, and the out of the money put spreads of 40.90s expired out of the money. So that was full profit. So that was about a $600 trade on 5 cents or $5 worth of premium. I don't hit those often, and I will admit that I chickened out and I bought it at 5 cents and closed it at like 250 or 250 bucks. Although I knew in theory it should hold. That's one thing. I've got diamond hands on the credit spreads, but paper hands when I'm long. Even though even though I quote unquote know it should happen, I see I've got that nice profit on the long option or long stock. I tend to take it too early. That's one of the things I'm working on, being a little more disciplined in.
Fantastic. Well, McGraw, Paul, thank you so much for sharing. Everybody enjoyed it. It was fantastic. And everybody have a great day.
Okay, and I got a dentist appointment, so I gotta get going.
All righty. Thank you.